Sydney house rents just jumped $50 a week. Not in a year, in 90 days. That's the fastest quarterly rent growth in 4 years. And it happened before the budget's tax changes have even formally taken effect. The cash rate is sitting at 4.35% after 3 hikes this year. House values, well, they're at 4-year lows, and investors are heading for the exits. So today, I'm doing something I don't do often. I'm going to make a call. 3 scenarios for the next 2 years, and I'm going to put a number on each one, tell you which one I think plays out, and exactly which suburbs win and lose in each. If you're new here, I'm Sean, and this is PropSpotter. We do 3 things. We research, we run every market in the country through more than 30 institutional data sources. We source, we find and negotiate investment grade properties for a fixed fee, no commissions, no kickbacks from developers, and we coach. We stay with our clients long after settlement. We keep the client book deliberately small. Quick disclaimer before we start, this is education, not financial or tax advice. Everything today is scenario analysis. Nobody has a crystal ball, including me. What I do have is data and a framework that works in all 3 of these futures. Let's get into it. To understand where we're going, you need to be clear on the 2 forces colliding right now. Force number 1, the 2026 federal budget. From the 12th of May this year, if you buy an established property, negative gearing is gone. The 50% capital gains discount is gone too, replaced with inflation indexation and a 30% minimum tax. But, and this is the part driving everything, new bills are carved out. Buy new and you keep the concessions. The government has effectively built a tax funnel pointing every dollar at new construction. Force number 2, interest rates. The RBA hiked in February, March, and May. The cash rate is at 4.35% and it held in June. Borrowing capacity has been crushed, and some of the banks are now forecasting price declines running to the end of 2027. Now, here's what the July data is telling us. 3 independent rent reports, Domain, PropTrack, and Cotality, all landed in the last fortnights, and they all point the same direction. Sydney house rents up $50 a week in a single quarter to a record $850 a week. National vacancy somewhere between 1.2 and 1.6%, depending on whose numbers you used. A balanced market is 3. Rental listings nearly 17% below the 5-year average. And over 5 years, national rents are up more than 40%. One industry researcher put it bluntly, we're not heading towards a rental crisis, we're already in one. And the vacancy data backs this in. The government's official modelling says these tax changes should add less than $2 a week to rents. $50 in 1 quarter in Sydney says the market has a different opinion. And if this feels familiar, it should. I covered this in my video on the 1985 negative gearing experiment. They scrapped it, prices boomed 27%, rents exploded, and within 2 years, the same government quietly brought it back. History doesn't repeat itself exactly, but it rhymes. So as I promised, 3 scenarios, let's go. Scenario 1, I'm calling it the squeeze, and I'm giving it a 50% probability of being likely. This is my base case because honestly, it's not a prediction, it's already started. Here's the mechanism. Rates stay high through most of 26 and 27, we get no meaningful cuts. Established property investors look at the new tax math, and a growing number of them decide to sell. Domain's head of research is already reporting long-term investors saying, in effect, we've done well, but let's get out before the changes bite and before prices fall further. Now think about what each of those sales actually does. An investor sells to an owner-occupier, one rental property leaves the market, but the renter does not disappear. Roughly 30% of Australian homes are privately held rentals. Every exit shrinks rental supply into a market that's already at 1.2% vacancy. So in the squeeze, you get a strange 2-speed market, prices flat or drifting down 5 to 10% in investor-heavy segments, while rents run 7 to 10% up a year, maybe more in the tightest markets. Falling prices and surging rents at the same time, which mechanically does one thing, yields explode upward. Where does this show up hardest? Follow the rent growth and the investor concentration. Darwin, rents up around 18% in a year, the tightest capital story in the country. Suburbs like Palmerston are ground zero. Perth, around 10% annual rent growth. Investor-heavy corridors like Armadale and Bulga are repricing fast. And in Sydney's west, places like Blacktown and Liverpool, that $50 citywide jump is landing on tenants who were already stretched because investor-owned houses dominate those rental markets. And a warning on the flip side, high investor concentration cuts both ways. Markets like Logan in Queensland, which long-time viewers know I treat with caution, have deep investor ownership. If exits cluster there, that's where you see price weakness even when rents climb. Rent growth does not automatically make a suburb investment grade, the filters still decide. So who wins in the big squeeze? Investors holding assets where the cash flow carries the property. Sub 1.5% vacancy, genuine yield, tight supply. Prices may fall, but rents will continue to rise, effectively lowering the cost of holding over time. Who loses? Anyone banking on tax concessions or a growth story to rescue a negative cash flow asset. That era ended on May 12th. Suburbs with high vacancy rates will also see slower rental growth rates. Scenario 2, the new bill Stampede. 30% of this happening, and I want to be careful here because part of this scenario is guaranteed. The question is whether it becomes the dominant force in the market. The logic is simple. The budget didn't remove the incentive to invest, it redirected it. If new bills are the only place you keep negative gearing and CGT concession, the herd runs at new bills, house and lead packages, off the plan towers, the outer growth corridors. In this scenario, corridor land prices inflate hard through 2027. Developers reprice, and every property marketer in the country rebrands overnight as a new build tax saving specialist. You will be sold this relentlessly. Here's the problem, and it's the same problem I showed you 2 weeks ago when I ran 6 Melbourne growth corridor suburbs through our filters live on this channel. All 6 failed. Suburbs like Calcalo, Donnybrook, Fraser Rise and their cousins, the Tarneets and Clyde Norths and Micklehams of the world, failed the 2 tests that matter. Vacancy rate above 1.5% and building ratio above 1%, meaning the supply tap is wide open and stays open. Ladies and gentlemen, a tax deduction does not fix oversupply. When your rental competes with 300 identical new houses on the same estate and another release next year, your rent doesn't grow. Your land is the smallest component of your asset. You've bought a depreciating box with a tax feature. But here's the part of this scenario almost nobody is talking about, the shadow side. If the herd stampedes into new bills, who's buying quality established stock? Fewer investors, less competition. Established high-yield properties in supply-constrained suburbs get structurally ignored and mispriced. That stampede would create its own buying window. One more reality check on why I capped this scenario at 30%. The construction pipeline itself can't absorb the stampede. The National Housing Accord needs 420,000 homes to stay on track for 1.2 million by 2029. Actual completions, just over 307,000. We're 112,000 homes are behind 21 months in. Labor shortages, financing costs, planning delays, the funnel points at a pipe that's already blocked. Who wins in this stampede? Landowners in the corridors, developers and marketers. Who loses? Essentially, the investors who buy one of this last, holding brand new stock in oversupplied estates, a tax deduction with no rental growth. Scenario 3, the pivot. 20%. This is the one every mortgage holder is praying for. The story, 4.35% does its job. The economy slows, inflation cools faster than expected, and somewhere in 2027, the RBA starts cutting 50 to 100 basis points. Borrowing capacity snaps back. But here's the key. It snaps back into a rental market with listings 17% below average, a construction pipeline 112,000 homes behind, and 2 years of investors having sold down established stock. Demand returns before supply possibly can. That's not a soft landing, that's a spring compressing. Why only 20%? Because the RBA hiked 3 times this year. You don't hike in February, March, and May and then cut by Christmas. For the pivot to arrive, our 2-year window inflation has to break decisively, and nothing in the current data says it's breaking. Possible, not probable. If it does arrive, recovery starts where affordability lives. And the standout candidate in this is the city everyone's been writing off, Melbourne. Cheapest mainland capital to rent a house, $600 a week against Sydney's $850. Domain is already reporting people moving from interstate just to rent there. When rate cuts restore borrowing power, the cheapest big city with the deepest job market re-rates first. Within Melbourne, it's the value of the West, the Sunshine West, the St. Albans, the Footscray, rental markets, established suburbs with real infrastructure, genuine yield, and none of the corridor oversupply. Longtime viewers will remember Sunshine West was the only suburb to cleanly pass both of our filters in the corridor video. That's not a coincidence. And beyond Melbourne, Hobart's northern suburbs, your Glenorchies, Mooners, Claremonts, where rents have already done nearly 8% in a year off a much lower base. Who wins in the pivot? Whoever bought quality yield during the fear window of 2026. They collect the cash flow now and the growth on the turn. They get paid twice. Who loses? The people who waited for certainty. Certainty is the most expensive thing in property. So 50, 30, 20, the squeeze, the stampede, the pivot. Now, let me tell you the most important thing in this entire video. I just spent 10 minutes on scenarios, and here's the punchline. You don't actually need to know which one happens. Look at what wins in each. In the squeeze, tight vacancy, high yield established suburbs win. The cash flow carries you while the rents surge. In the stampede, those same suburbs win because the herd is busy overpaying in the corridors and leaves quality established stock mispriced. In the pivot, they win again because affordable, supply constrained markets re rate first when capacity returns. Same asset, three different futures, wins in all three. That's what a robust asset looks like, and it's exactly what our filters are built to find. Vacancy under 1.5%, building approvals ratio under 1%, genuine gross yield, affordability headroom. Those numbers don't care which scenario plays out. Prediction is what people do when they don't have a process. We at PropSpotter have a process. So here's my call on the record, July 2026. The squeeze is the base case. Rents keep running. Prices stay soft in investor-heavy markets. And the best value buying window this decade quietly opens for the investors who can read the data instead of the headlines. I'll revisit this video in 12 months and we'll market against reality. Subscribe if you want to see me held to it. If you want to know which suburbs pass all of our filters right now in this exact environment, that's literally what we do. We research the markets, we source the property, and we coach you along after settlement. We take on a small number of clients and we're selective. So if that sounds like you, speak to us. The market's about to split people into two groups, the ones who followed the herd into the tax funnels and the ones who followed the data. Choose carefully. I'm Sean, this is PropSpotter, and I'll see you in the next one.